Money is a fascinating subject and full of curiosities. So let's find out what this chapter, Money and Credit, has to teach us. Hi friends, welcome to Class 10 Economics, Chapter 3, Money and Credit. So I have divided this chapter into two parts. In the first video, we shall discuss all about money. We shall see money as a medium of exchange, forms of money, and the loan activities of banks. While in the second video, we shall discuss all about credit. We shall see the terms of credit, the sectors of credit, and self-help groups. So let's start. First, let's discuss money as a medium of exchange. So the use of money spans a very large part of our everyday life. Money can help you buy all kinds of goods and services. A person holding money can easily exchange it for any other commodity or services that he or she may like. Thousands of years ago, there was no concept of money. Then, how did people buy and sell goods when there was no money? This was done by a special system called the barter system. In this system, the goods were directly exchanged without the use of money. But this had many limitations, such as the double coincidence of wants. That is, both parties have to agree to sell and buy each other's commodities. Let's understand this with the help of an example. Let's take the example of a fish seller. He wants to sell his fish and get rice in exchange. But the farmer growing rice needs clothes in exchange for fish and he doesn't want fish. Thus, their requirements don't match. Thus, from this example, we can conclude that double coincidence of wants is very necessary for barter system. So, if both the parties don't agree and don't have the same requirement, then barter system cannot take place. So, here comes the role of money. Money eliminates the need for double coincidence of wants. When money is introduced in this situation, then a person can sell his goods to anyone in exchange of money and then use that money to buy what he wants. Since money acts like an intermediate in the exchange process, it is called a medium of exchange. Now, let's discuss the second topic of this video, which is forms of money. So, since very ancient ages, Indians used grains and cattle as money. Then came the use of metallic coins like gold, silver, and copper. After that, modern forms of money like paper notes and coins were introduced. They are known as currency. Modern currency has no value of its own. So the notes we use today have no value of its own and they're just like paper. But they are accepted as a medium of exchange as they are authorized by the country's government. In India, currency notes are issued by the Reserve Bank of India. No individual can legally refuse the payment made in rupees. The other form in which people hold money is in the form of deposits with banks. So at a point of time, people need only some money for their day-to-day needs. For example, workers who receive their salaries at the end of each month have extra cash at the beginning of month. The people can deposit their extra cash with the bank by opening a bank account. Such deposits are called demand deposits. Now, let's see few more features about these demand deposits. So the banks also give an extra amount as interest on these deposits. The people have the provision to withdraw their money as and when they require. A person who has a bank account can also make payments through checks. A check is a paper instructing the bank to pay a specific amount from that person's account to the person in whose name the check has been issued. Let's understand this check with the help of an example. So consider the example that Ram has to pay rupees 50,000 to Rahul. But he doesn't have so much cash, but he has a demand deposit with a bank. So that bank will give Ram a check and he can mention the name of Rahul on that check. And also mention how much money he has to give Rahul. So he will mention rupees 50,000 on the check and also mention Rahul's name on the check. Then he will give that check to Rahul and Rahul will go to the bank with that check. And the bank will transfer rupees 50,000 from Ram's account to Rahul's account. So in this way, money is transferred without the use of cash. Now, what do the banks do with all these deposits which they accept from the public? So 15% of the deposits is kept as cash with the bank to pay the depositors who might come to withdraw their money. But the major portion of the deposits is given as loans by the bank. So banks make use of the deposits to meet the loan requirements of people. The banks mediate between those who have surplus money, that are the depositors, and those who are in need of money, that are the borrowers. So banks provide a link between the depositors and the borrowers. And the banks charge higher interest on the loans they offer rather than the interest on the deposits they give. So the interest charged from the borrowers minus the interest paid to depositors is the main source of income of the bank. Thus, the interest charged from the borrowers is very high and the interest paid to the depositors is low. And the difference between the interest charged from borrowers and the interest paid to the depositors is the source of income for the bank. So this was all for today. Thanks for watching.